Absolutely.
Okay, hello everyone. Thank you for joining us today. Um, we are excited to have you join us to discuss this very important topic. And today our webinar is called Legal Structure Essentials for CFOs, how to ensure that your entities and intercompany transactions position your group for growth. And with me, our special guest today is Paul Sutton. Paul is the founder of LCN, and he's a corporate lawyer and expert in the legal implementation of transfer pricing policies for multinational groups. So thank you, Paul, for joining us and for sharing your expertise, best practices to help our attendees have a better understanding about this important topic.
Thanks, Rosie. Great to be here.
Thank you. And I guess I have to introduce myself as well. My name is Rosy Lopez Gross, and I am part of the Athennian team. I am a senior industry consultant for global operations here at Athennian. And so let's start our discussion. But before, let's go through some basic housekeeping items. May, if you can go to the next slide. Oh, well, this is what we will cover. The importance of legal entities and intercompany transactions. The second point is transfer pricing fundamentals. And as a third point, one of the key takeaways that you will have today are some best practices and common pitfalls around this topic. So these are the housekeeping rules I was talking about. I just wanted to share that you will receive an email with a link to download the full deck that we're going to share today. The recording of the webinar is also going to be available for everyone soon. And please share your questions or comments with us in the chat box. We will have some time dedicated for Q&A at the end of the webinar. And yeah, before further ado, let's start with our first question, Paul. So we know this is a very important topic, sometimes overlooked by multinational companies and groups of companies. So let's start with a basic question. Why should CFOs care about their legal entities and the legal implementation of intercompany transactions? Don't investors and shareholders just care about the consolidated numbers?
Yes, so it's a really good question, and it is totally natural to look at the consolidated position, the consolidated profits of the group, and so on. So we're not saying in any way at all this is not a valid and important perspective. But the key message is that the legal entity perspective and management of legal entities is absolutely critical in its own dimension. And there are really three key reasons for this. One is that legal entities and transactions between legal entities are really the building blocks for tax compliance and transfer pricing compliance, and we'll dive into this a little bit more. So that's point number one. Point number two, as you know very well, Rosie, legal entities are the fundamental point of focus for directors' duties and for compliance, regulatory compliance in particular, because directors tend to owe personal fiduciary duties in relation to the specific entities and not just the group-wide perspective. And the same applies to regulatory obligations affecting entities. And the third point is really ultimately legal entities are the only way that a group can interact with the outside world. And this applies to things like enforcing claims and enforcing IP rights, which means that in order for the group to have a handle on things like intellectual property, which is often a major value driver, it needs to be able to show to stakeholders, so investors, potential purchasers, and so on, that it actually has a handle on where specific intellectual property rights sit within the group so that it can be enforced and maintained appropriately. So really those are three key reasons why legal entity perspectives and relationships between legal entities are absolutely fundamental.
Yes, Paul, thank you. So yeah, so it's not only the big picture, but of course, there's a lot of value in understanding all these details at the legal entity level. And Paul, for some of our attendees that may not know the basics about what is transfer pricing, can you please explain the basic concept of transfer pricing and why it's critical for multinational companies?
Yes, so for multinational groups which have an international footprint, transfer pricing is often regarded as the number one tax risk affecting that group or that corporate group. And what transfer pricing effectively is, it's the international set of rules which determine where profits are taxed. In other words, it's a bit like dividing up the pie of taxing rights between each of the countries in which the group operates. So if you think of a large corporate like say Starbucks, let's imagine that the US entity holds IP rights and is granting intra-group licenses to operating entities in the UK, France, Germany, China, so allowing those local operating entities to use those IP rights. What transfer pricing says from a high-level perspective is we need to look at the amount of the royalty that is paid by these operating entities to the IP owner in the US in this case, and we need to set that amount as being an arm's length amount. So the reference point is what would an unconnected third party have paid in that situation for that transaction? And when you think about it, the two ends of the transaction have opposite interests. So from a UK perspective, if the UK entity pays a royalty which is too high, then HMRC in the UK will say, hey, you're artificially stripping out profits. You're not making any profits in the UK, and therefore you're not paying enough of tax. But at the opposite end, you have the IRS saying, well, if the royalty is too low, you're giving away your crown jewels for nothing. You're not receiving an appropriate remuneration for the US contribution. And therefore, we're going to revisit that intergroup pricing. And so this concept of arm's length pricing of arm's length or arm's length pricing of intragroup transactions, it applies to services, supply of goods, licensing of IP, finance, so the whole range of the way that the group operates. And that's really the transfer pricing problem or challenge, which is to design a set of intercompany transactions which is appropriate from a governance perspective and which is robust enough from a transfer pricing perspective so that when these challenges come, the group is going to be able to demonstrate compliance with local transfer pricing rules and the arm's length principle, the arm's length standard as the overall concept here.
And Paul, when you say this is the number one task risk for these groups, then can you tell us more about what the actual risks are? And if you can also share some examples of these risks and some of the issues around transfer.
Yeah. No, absolutely. So there are a number of different tax risks which come into play here. One is that transfer pricing compliance is actually very prescriptive. So there's a set of documentation that needs to be prepared and kept up to date. And very often, depending on the individual country, there will be fines and penalties which apply just for failing to produce the required documentation when asked. So that's one set of risks. Another set of risks is just the risk of that challenge at one end of the transaction and what we call an adverse transfer pricing adjustment. In other words, if one local taxing authority says this particular entity in our country is overpaying or underpaying for related party transactions, and therefore may claim that there has been an underpayment of tax, and interest, fines, and penalties applied to that underpayment. And then, unfortunately, it's not just about transfer pricing, which is about allocating corporate taxing rights. It's also about withholding tax, sales taxes, customs duties, and so on. So, in effect, the intercompany transactions and the definition of those transactions in the intercompany agreements becomes the central source of truth, which delineates or describes the transactions for a whole load of different purposes, including transfer pricing, corporate tax deductibility, and so on.
And Paul, in terms of some examples, are there any prominent examples that you can share of some companies that may have overlooked the importance or mitigating these risks associated with transfer pricing and intercompany transactions?
Yes, so there have actually been more and more cases which has been litigated in transfer pricing or threatened in transfer pricing. One significant example in the news was Microsoft. So Microsoft announced, I think it was November last year, that it had received a claim from the IRS for 29 billion in claimed underpaid taxes, which is based on a transfer pricing ground. There have been a number of other groups which have been in headlines, including McDonald's, Coca-Cola, Skechers, and we can come on to some of the specific lessons from those cases as well. So it applies definitely to the super large companies, but also it's an easy win in terms of smaller companies and tax authorities challenging the tax returns and transfer pricing compliance of smaller companies as well. So it's not just a risk for the ultra large corporates out there.
And Paul, you've shared with us the next slide with some of the common mistakes and issues. May, if you can share the next slide. Can you tell us more about these common mistakes that you commonly see?
Yeah, absolutely. So I'm just going to focus for simplicity on the top three bullet points on the left-hand side. So common errors and issues as illustrated by three recent cases. So number one common error is failing to document intercompany transactions through an intercompany agreement. In other words, you don't have an agreement at all. And a recent case on that was Aspro. So this is a US case. It was Aspro Inc. And the scenario there was that over a number of years, Aspro, which the US company, was making regular payments to its shareholders. And it was claiming corporate tax deductions for those payments on the basis it claimed that these payments were in the nature of fees for services, consulting type services or management type services. But the problem was that the group had not maintained intercompany agreements, had not documented those transactions by way of intercompany agreement. And so it was unable to prove the nature of those payments. So were the payments made, were they dividends? Were they fees for services? Because it hadn't documented that in legal form, it was actually unable to back up the corporate tax positions and the tax deductibility, which meant that those corporate tax deductions for the expenses were denied. So that's number one common error, is just failing to have an appropriate agreement in place for all your intercompany transactions. Number two is Coca-Cola, which was obviously a very significant case, which has a major impact. So it's still being litigated at the moment. In 2020, there was a US tax court decision which ruled in favor of the IRS, and it gave rise to an incremental tax liability of the group of around 13 billion US dollars. And the issue that there was the group did have intercompany agreements in place, but the terms of those agreements directly contradicted its tax filings, directly contradicted its claimed transfer pricing policies. And what the US tax court said was, sorry guys, it's a one-way street. You, the taxpayer, you had complete choice as to what you put in your agreements. You don't get to disavow your own agreements by saying, oh, sorry, we didn't make a mistake, or we didn't take into account what we say is the economic reality there. You don't get to do that. Only the IRS gets to bring those kind of arguments to overturn an intercompany agreement. So that's mistake number two, which is agreements that were just allowed to get outdated, outmoded, didn't match their transfer pricing policies. Third key error is creating a structure and not documenting a commercial rationale. So this is illustrated by the case of Skechers, the shoe company, last year in 2023. It put in place a structure whereby it hived down. So this was a US structure. It hived down IP assets into a new subsidiary, and then there was a chargeback of royalty to the original operating country. And while it had voluminous tax-focused documentation explaining why this structure was advantageous from a tax perspective, there was no serious attempt to document the commercial rationale, the legal rationale. Why does it make sense to do this at all? And so in that case, that whole transaction or set of transactions was in effect disregarded as being a sham. And that was because of this failure to create a legal rationale for the arrangements. So I'd say those are the three most common or most serious mistakes. But there are other ones as well that we can talk about.
Good, thank you, Paul. And so let's take this opportunity to ask our audience. We have prepared 3 poll questions that we're going to share during the webinar. The first one is, what is your biggest challenge in managing your company's intercompany transactions and legal entities? There are 3 options for you to check from. One being understanding and implementing transfer pricing policies, or ensuring compliance with international tax regulations, or preparing for investment rounds or exit events. So if you can please pick one of the, that's most applicable to your case, we will then share and review the results. And Paul, now that we have asked that to our audience, and let's see what they have to share, but now that we understand the risks and the importance associated to transfer pricing policies and intercompany agreements, what would be then the starting point for CFOs when reviewing their legal entities and their intercompany transactions? What do you recommend?
Yes, so the starting point is to get a handle on what have you got, and the what have you got includes transfer pricing policies which are currently in place, and for some groups above a certain threshold, so this is 750 million euros, they are subject to certain reporting requirements based on the OECD transfer pricing guidelines. So they will tend to have transfer pricing documentation in a certain format. But for smaller groups, they may just have transfer pricing memos or advice notes or something setting out the different types of intercompany transactions. So obviously that's the starting point, making sure that you've got a handle on legal entities, making sure that you've got a central source of truth for that, because often, as I'm sure you've come across a lot, different teams within a corporate, like the company secretarial team, the tax team, maybe the compliance team, may have different sorts of records. So they may maintain their own records of legal entities and entity names, and sometimes these records don't match. So it's really important to have a central source of truth as regards legal entities, because they do change over time. And then it's looking at what intercompany agreements do you currently have in place and starting to do a health check review of those intercompany agreements. So on this slide, we've shared a framework that we tend to use when we're working with clients for the first time. And it's a framework for looking at a particular transaction type and how you review the agreement. So perhaps I better backtrack and say, what do we mean by transaction type? What I mean is, going back to that Starbucks example, one transaction type could be the license of intellectual property. So that could be a bundle of trademarks, brands, and know-how, for example, that is being licensed by Starbucks in the US to operating entities. So that could be one transaction type. Another transaction type could be the supply of central support services. So if you've got a regional entity which is providing back office support, HR, accounting support, legal support to a number of subsidiaries within that region, that provision of regional or central support services is a separate transaction type. And similarly, if you imagine a group which deals with physical products, so distribution agreements, agreements whereby goods are sold by one entity to another, which then sells the goods to local sub-distributors. So each of those are referred to as a transaction type. And what you're really doing is, for each transaction type, you're looking at a sample or one of your existing agreements in place and say, well, does it match? Do the agreements match what your TP documents say? And that's where these 4 segments come into place. So point number 1, you're looking at the character of the transaction. So does the agreement, the way it describes the transaction, does that match what the transfer pricing documents say in terms of what are the distinctive performances or distinctive duties of the party? Number 2 is risk allocation. So risk allocation between legal entities is a key concept in transfer pricing. It's a key feature of our everyday life. So you expect to pay more for goods or services if you have a stronger guarantee so that if something goes wrong, you'll get compensation. So you tend to pay more for those kind of scenarios. And it's the same in intra-group transactions. So you need to look at what the transfer pricing documents say about which entities are intended to bear which risks. So that includes things like claims risks or product liability risks or recall risks and or market risks or whatever, and say, well, what does the agreement say about those risks and which entity bears what? So that's the second key area. Third key area is about IP ownership. So the ownership of intangible property rights. And this is really where Coca-Cola fell down, is because its agreement said that all IP rights were held centrally within the US, whereas the transfer pricing policies only made sense if these local entities were generating significant value in terms of local marketing IP. So you're looking at the agreement and say, well, who owns what in terms of pre-existing intellectual property, and who owns what in terms of the fruits of the ongoing obligations of the parties. And then the final area for review is looking at the pricing clauses and the mechanisms in the agreement for post-year-end adjustments. Does that match the transfer pricing policy that the group claims that is applying? So those are the key four areas that we tend to look at, and in which anyone needs to really start with, where they've got existing agreements in place, but maybe they were put in place 5, 10 years ago, and you need to make sure that they are up to date. And then there's a fifth area which we put on the right-hand side, which is general fitness for purpose in terms of the agreement. So does it have the right parties? Is the start date appropriate? Is the duration or notice period appropriate? Is it written in a language which people can understand? Because the whole point of these agreements, these are not written by lawyers for lawyers. The whole point of these agreements is for when the tax audit comes, and it almost certainly will come, and this may be in 3, 4, 5 or more years' time, can the group present its agreements, present its policies, and they just obviously match? So we need to keep the agreements as simple as possible in terms of the language used. We need to avoid unnecessarily long agreements. We need to avoid unnecessary procedural provisions which may not be followed. And then at the bottom is the corporate benefit test, which is basically saying, if you were if you were a director on behalf of each of the entities, would you sign? Would you put your name to this as being something which is appropriate in the interests of each entity of which you are a director? So this is an overview as to the process for health check reviewing agreements that you might already have.
And Paul, I see this not only as a great map for reviewing particular transactions, particular agreements, but also it helps prioritize which agreements to update first, to review first, based on the results of the different key areas for CFOs and for leaders looking at reviewing their existing intercompany agreement inventory. But I also wanted to ask you, because yes, there's a legal component, but of course there's a task rig associated. Can you share who do you think is a natural owner, or under what team falls the responsibility and the burden of driving this process naturally, or
yeah, I think it's a really interesting question, and I think historically it's just fallen between two stools, because tax people will say, well, okay, I know this is important for transfer pricing, but I'm not a contracts lawyer, so I shouldn't be drafting these agreements. But maybe the in-house legal team, maybe that's not where they regard their value adds. They think, well, their main focus should be corporate finance transactions, M&A transactions, providing strategic advice to the board and so on, which is totally valid. And they're saying, well, isn't this left pocket, right pocket stuff? Isn't it all intergroup? Who cares? And by the way, I'm not particularly up to speed on what transfer pricing actually means and specific concepts. So certainly it's been in the case in the past that has just fallen between two stools. In terms of which team should own this, I would say, generally speaking, we're talking about two groups of companies or corporates here. Generally speaking, for regulated groups, such as in the financial services sector, it tends to be owned by the compliance team or the regulatory team. And the reason for that is that regulatory compliance is just the ticket to play. You know, it really trumps everything else. If you fall down on that and you can't carry on business, then you've lost everything. And very often, specific functionality is required in intercompany agreements in that situation. So often it's that team which takes initial ownership of that, and the tax function needs to make sure that it is at the table. And those agreements, in addition for having the regulatory functionality, it also has the correct transfer pricing functionality. For other groups which are not so regulatory heavy, it tends to be that it's the tax function which ultimately holds the baby, because ultimately the major risks tend to be transfer pricing, withholding tax, corporate tax deductibility, and so on. In other words, they probably get the blame if something goes wrong, and therefore they should be most motivated to get things right. And therefore, it's up to them to say, okay, what have we got here, and what are the resources available to us? Should we reach out to our in-house legal team and get support that way, or do we need to look elsewhere for support?
Okay, and Paul, I think this is a good opportunity to ask a second question to our attendees, understanding how the process of reviewing intercompany agreements should be, what are the key areas to look into. Let's ask our audience, how often do you review and update your intercompany agreements and legal entity structures? And the three choices are annually or even more frequently, every 2 to 3 years, or rarely or never. Let's see then what they have to say about that. And Paul, we have talked about companies where we can assume some work has been done on the mapping of the transactions, creating some of the intercompany agreements, and then we may have new leadership or a CFO wanting to look at this in detail for strategic purposes, either for growth or for a tax audit coming up. But what about companies where no intercompany agreements have been created? So for a group that has not yet legally implemented these agreements, what are those first key steps they should take?
Yeah, great, and thank you for sharing this slide already. So, we look at this as 5 key steps. So I'm just going to go through it relatively quickly, hopefully to get a feel for the approach. So step number 1 is scoping, or rather high level scoping, I would say. So this is about mapping out: are we clear on our legal entities? Are we clear on the intercompany transaction types? So mapping that out into a matrix of what agreement types are needed, such as an IP license, in which case, which entity is going to be the licensor, which entities are the licensees, and what is the transfer pricing policy as regards how the royalty in that case, how it is calculated. So it's literally creating a tentative draft matrix. And maybe I could sort of pick up on the point that you raised before, Rosie, about prioritizing. So at this stage, it's a good point to say, out of this matrix, are there any transaction types that we really think that we need to prioritize and do first? And the reasons for, or the drivers for prioritization could be, well, we know that we're due a tax audit in this country imminently, so that could be a reason. It could be that there are known sensitivities in particular countries, or where countries are known to be more aggressive in their enforcement of transfer pricing. So countries like India and Italy, and maybe Australia and China and so on. So prioritizing by reference to country. Another factor could be by transaction type, in that if there are transactions which we know are more likely to be challenged, so transactions involving intellectual property, they're often an easy win. Another one would be management charges. It's often a really soft target for tax authorities. So looking at transaction types and known sensitivities, and also the volume of charges going under each transaction type, that can give you a good feeling as to which transactions to really look at first and nail down first. The second stage is really the detailed review to validate that transactions matrix. So that means detailed look at your current transfer pricing policies or your basis of intercompany recharges. It means a detailed look to make sure that you've correctly understood the group's contracting model. I don't know if you believe this, but a number of the groups that we work with actually have incorrect views in their transfer pricing documents as to which entities actually contract with third-party customers. So making sure that you've got accurate information about that, including the regulatory environment and which entities are regulated. Third stage is drafting, which is basically preparing for each transaction type, is preparing a tentative draft master agreement or template agreement. And this is basically a collaborative process between the lawyers or the legal team and the transfer pricing team to create an agreement which works from a TP perspective and also from a legal perspective. Step 4 is finalizing those agreements. And that includes what we call localization. So sometimes entities in particular countries need to have a different approach. And that could mean that because of different benchmarking that applies. For example, in India, in terms of the way that transfer pricing rules tend to apply, the tax authorities will always insist on using Indian comparables as opposed to regional comparables. And because they regard the Indian market as being different, it generally means much higher markup percentages in relation to transactions compared to equivalent services provided in other countries. So that localization can be because of different economic circumstances in those countries, or it can mean because there's a different legal setup, for example, in China to adapt to the local situation there. So finalizing those agreements means taking on board the different country requirements, but also it means looking at, well, what are the other stakeholders involved, such as withholding tax, customs duties, VAT, sales taxes, and so on, and making sure that the needs of those other stakeholders are at least consulted, taken into account before finalizing the agreements. And then step 5 is about implementing, which is not just getting the agreement signed, but it's also making sure that you're actually strengthening the governance process. So that usually means creating board briefing notes for the directors of each of the entities involved, explaining what is it that they're being asked to sign, why they're being asked to sign it, how it impacts the particular entities that they look after. So that process of getting informed consent, even though it's intergroup, is really important. And ultimately, the point here of the exercise, or the final step of the implementation stage, is to create a comprehensive online archive of signed and dated agreements, because the whole point here is audit readiness and making sure that you've got your agreements in one place, signed and dated, aligned with transfer pricing policies, so that when the questions come in 4 or 5 years' time, you can quickly find and produce those agreements, even if the people involved have changed. So that's an overview as to how to start from scratch if you're needing to create agreements and you have nothing in place already.
And Paul, so you've also shared another slide with us, focus more on the outcome. So as a way to summarize some of the key takeaways that you've discussed during their conversation today, what would be those steps multinational groups need to take to be tax audit ready and deal ready from a legal and governance perspective?
Yeah, yeah, thank you. So this is really by way of recap of what we've been talking about all along. So number one, identify all legal entities, and PE stands for permanent establishments, in other words, branches and rep offices and so on, which may not be a legal entity as such. But the key thing is to have the central source of truth in terms of that legal entity information. Number two is just like any project, is identifying all stakeholders. And we put on the right-hand side typical stakeholders who are often very materially impacted by the form and content of intercompany agreements. So that includes regulatory and compliance teams, directors' duties, intellectual property management, transfer pricing, and so on. So for each group concerned, it's really identifying who needs to be consulted as part of this process. Step 3 we've got here, which is clear accountability. So this goes back to the question that we are asking, well, who within the group should be accountable, should have ownership of the process of not just creating agreements, but also keeping them up to date. And the short answer to that question is it doesn't matter as long as there is clear accountability and it needs to be aligned with how the group looks at its priorities. Next step is to create a comprehensive portfolio of intercompany agreements. And so this is partly about looking at what you've got already and doing the health check review. And it's also about going through that 5-step process to fill in the gaps. And that might mean rewriting or replacing existing agreements entirely, or it may mean a combination of updating existing agreements and filling the gaps. And then point number 5 is about the ongoing review, because one of the lessons from the Coca-Cola case is the US tax court described the agreements as inconsistent and outmoded. So they didn't reflect the pricing policies as currently operated. They didn't reflect the ownership of intangibles as represented in the TP. So the point here that groups change, circumstances change, they may acquire new entities, they may lose entities as part of corporate rationalization processes. So it's vital to have this ongoing process of checking in. And that depends on how active the group is, whether it's every 6 months, every 12 months. We have various clients where it's actually a quarterly process because actually they're very active from an M&A perspective. So they constantly have updates that they need to their portfolio.
And Paul, once either a thorough review or this is done from scratch, a set of intercompanies agreements that are match the transactions, etc. Is there a way to have a system in place to future-proof these intercompany transactions? Is there a way to be proactive in the future so these so the companies can have a system to make this process less burdensome?
Yeah, that's a really good question, and we come across a lot of clients who made their lives unnecessarily complicated, and they created a whole internal industry for updating their agreements where actually they could have streamlined things. But to answer your question, unfortunately, you can't future-proof agreements as such, because just like any commercial relationship between third parties, if the intra-group circumstances change, either because the nature of the transaction changes or because the economic pricing or benchmarking has changed, then the agreements need to be updated. So you can't write an agreement and just assume that it will be evergreen for the next 20 years, because life doesn't work like that. But what you can do is you can make your life easier. So that includes things like removing unnecessary legal entities as part of, many large corporates have just ongoing programs of legal entity reduction, so eliminating unnecessary entities. Also simplifying and eliminating unnecessary intergroup transactions. So looking carefully at the transfer pricing policies and saying, is there a way that we can actually simplify the intergroup transactions without sacrificing tax robustness, and just cut out unnecessary complexity. The next thing that is really important is actually streamlining agreements. So one of the mistakes that we see time and time again is groups using different forms of agreements in different countries. So different applicable laws or different variants of agreements, where actually applying the same template agreement in an appropriate way, it massively simplifies the ongoing administration, but it's also a very powerful message from a transfer pricing perspective, because you're saying to each of the tax authorities concerned, these are the transfer pricing policies that we apply, and this is not just about your country. We apply the same policies in the same way with the same form of agreements in all these other countries as well. And yes, there will be situations where you have to localize, where you need to make an exception, but streamlining and standardizing means that you're massively reducing the workload. And the final thing I'd mention is, wherever possible, consider using multi-party agreements. So if you imagine a situation where you say you've got a parent company or a regional holdco, and it is providing central support services to 20 subsidiary companies within that region. Yes, you could document that with 20 separate agreements on similar terms, or you can actually incorporate that into the same agreement. And there can be pros and cons of doing that, but generally speaking, where you can standardize, you should. Where you can reduce the number of individual agreements without sacrificing tax functionality and tax compliance, you should. And all these things added together can make massive difference to the effort and time that is needed to keep agreements up to date.
And Paul, from a practical perspective, what do you see in real life? Are teams adding amendments to existing agreements? I can see this having these Frankenstein intercompany agreements with historical transactions informations, maybe involving the same group of companies. So if that's the case, is it worth having like a clean start or keeping that historical record? Like, what would be the best practice in that sense?
Yeah, it's a really interesting question, and the answer I would give is take a common sense perspective. So, if for example you've got an existing agreement relating to the supply of services as we were discussing, and if the only update that is required to this is that you're changing the cost plus markup, so you're adjusting the pricing, then it may not be necessary to re-sign totally new agreements, and it will just be a one-page addendum to those agreements saying we refer to the agreement entered into in 2023, and we are agreeing to amend that just in relation to the pricing. So for some situations, that can be the cleanest and simplest way of documenting it. For other situations, where there are more complex changes happening, or where it's not just one variable which is being changed, actually it can be simpler to update the whole agreement, because actually what you're aiming to achieve here is a year by year record. In other words, you're having your defense file for 2023 with the agreements that were in place there. You want an equivalent defense file for 2024 and so on. And so sometimes just re-signing new agreements can be the cleanest and most appropriate way of doing that.
And what about expiry dates? Do you recommend intercompany transactions to have them, or maybe just not have expiry dates, avoid them, so you
Yeah.
have the yeah. What do you recommend?
Yes. So generally, I would avoid um, expiry dates unless it genuinely is a transitional arrangement or it's a special case. Obviously, loan arrangements are in a different category because loans tend to be or often made on a specific term. So it might be a 5-year loan and might be priced accordingly. So that's the special case. But for other arrangements like supply of services, license of IP, appointment of distributors, generally speaking, it's better to have that as an ongoing agreement which is capable of being evergreen, but you still need to review it. But you don't need to unnecessarily create new agreements just because an expiry date has been hit and you're left with a gap that you didn't need to have.
Thank you, Paul. And I'm just going to share the last question that we have here for Paul. And so after listening to Paul and based on what you've learned today, this is for the attendees. How would you rate your company's current readiness for an international tax audit and potential growth or exit events? So the poll should be coming up very soon. There it is. So how would you rate your company's current readiness for an international tax audit and potential growth or exit events? Fully prepared, somewhat prepared, or not prepared? And I just want to remind you, we do have a Q&A box. We have a couple of questions there that I would like to share with you, Paul. One
Oh,
is double taxation a risk for not having transfer pricing policies in place?
sorry, what was the question again?
Is double taxation a risk of not having transfer pricing policies in place?
Absolutely, yes. So, and the particular risk of double taxation is that you might get a tax challenge in one country. Um, and for example, in that Starbucks example, like if the UK tax authority says actually the UK Starbucks entity is paying a royalty that is too high, it should be reduced. Well, the IRS is not necessarily going to agree with that challenge or that adverse transfer pricing assessment. And you might, although there is a process whereby, or to encourage tax authorities to agree adjustments between themselves, that doesn't always happen. And therefore, the risk of double taxation is that a tax adjustment or transfer pricing adjustment, which is claimed in one country, may not be agreed at the other end of the transaction. So you end up paying tax twice on the same profits.
Another question is, I'm just thinking that this may be one of the reasons why maybe some companies are not doing this review proactively. It says, can these intercompany agreements review result in dissolutions, corporate reorganizations?
Um, yeah, absolutely. So, you can look a corporate group is a bit like a garden. It's the nature of the garden is the weeds get out of control, the hedges need to be trimmed. So it's a constant process of growth and pruning that needs to happen. And often the updating of intercompany agreements goes hand in hand with just the natural periodic review of a corporate structure and what needs to be removed and how fit for purpose is the corporate structure and the legal entities involved. So yes, often these two things do go together.
Thank you. And those are the questions we have. Maybe, May, can you share the results of the polls? And Paul, if you have any questions based on the results, you can comment. So this is the last question. So most of our attendees feel that they're somewhat prepared.
Yes, so just to comment on that. So we work with a really wide range of corporates. So some of them are ultra large corporates, and some of them are scale up companies that are PE backed that are very much in their growth stage. And so we come across a very wide range of readiness even amongst companies in the billions of worldwide revenue. So at one end of the scale, there are a number of groups that we've worked with, which are extremely sophisticated in the way that they handle agreements. And this is not just in terms of quarterly reviews and so on, but they also have internal policies that they will not allow an internal charge to be booked unless it is backed up by an appropriate intercompany agreement. So some corporates are at that end of the scale. Others are very much playing catch up, given that the transfer pricing environment has changed massively over the last few years. So it's natural for a number of groups to be in the process of updating and improving their internal processes and the quality of their intercompany agreements.
And May, do we have the results for the other two questions? For the biggest challenge in managing entities, what is your biggest challenge in managing your intercompany transactions and legal entities? The biggest one is ensuring compliance with international tax regulation, and that is understandable, given all the information and all the nuances and challenges that you've shared, Paul. And what about the other question, May? How often do you review and update your intercompany agreements and legal entity structure? Rarely or never is the most common answer.
And I'd say, that's reflected in a lot of the transfer pricing litigation that we've seen, which is still playing out in the courts. And I think a lot of the reluctance has come, or the perceived challenge has been this falling between two stools problem that people have faced. Who should own it? And it seems like it's too difficult, but so it's something that gets neglected. But what I would say is it's just like anything else. help is available. And actually, there's a lot that can be done to make your life as easy as possible. So as we were discussing, streamlining agreements and not making them unnecessarily complicated. So yes, it does require focus to get up to speed, but then you'll have made your life a lot more manageable going forward just by having an appropriate starting point.
Thank you, Paul. And well, we finished our webinar a little bit earlier. We would like to share our LinkedIn. You can find Athennian on LinkedIn, but also you can follow Paul. He's very active and a thought leader in the topic of transfer pricing. And you can follow me as well, sharing news articles and relevant topics about global operations, anything impacting legal entity management. So thank you for joining us today. Thank you, Paul. Thank you. I didn't say that you are connecting from London, UK. So thank you for taking the time at the end of your day to join us, because I'm connected from Canada.
It's a pleasure, and thank you for having me. It's been great.
Thank you.